Look at these two balance sheets. On paper, they are identical to the penny. Both show standard revenue streams, predictable liabilities, and healthy cash flow. But one belongs to a legitimate enterprise. The other belongs to a highly efficient criminal laundering vehicle. Criminal organizations generate massive profits, but those profits possess imperfect utility. Raw illicit cash has value, yet deploying it in the open market risks immediate asset seizure or prosecution. Modern laundering converts raw illicit funds into legally circulating wealth. The central scale, principio chiave, shows individual transactions often mirror legitimate activity. Launderers fabricate document-heavy narratives to justify the flow, providing a mathematical reason for every movement. Because illicit capital now frequently enters the global system already digitized and backed by heavy documentation, the traditional image of physical cash smuggling is largely obsolete. The bottom right corner clarifies why we must move past the traditional three-phase model of placement, layering, and integration. Modern digital fluidity compresses these steps across multiple jurisdictions instantly, rendering the old cycle too rigid to capture current tactics. To identify these networks, we must map the true economic functions of illicit capital and observe how its presence distorts the mechanics of a free market. Modern money laundering operates as an aggressive, continuous process of financial integration and market manipulation. The first function is conversion. Raw profits must be transformed into corporate shares or commercial invoices. Box 2 highlights shielding. The launderer interposes proxies, shell companies, and trusts to ensure apparent ownership diverges from actual availability. Integration sees the illicit capital active in the legal economy, securing real market power. Accumulation proves these operators act as aggressive investors, using capital to capture market share. Finally, organizational stabilization reveals laundered capital provides the operational fuel for the next criminal cycle. Successful integration also provides a mimetic social function. The launderer assumes the role of a legitimate investor, using a shield of societal and institutional cover to protect their personal profile. These 5 functions work together through a continuous pipeline of complex operations, transforming a single crime into a perpetual economic engine. Illicit capital serves as the active, expanding lifeblood of an ongoing enterprise, far exceeding the threat of a simple, static stolen asset. Laundering has evolved from the movement of heavy physical wealth into a decentralized network of digital capital that is fragmented across the globe. The traditional phase centered on physical cash and precious metals. By the 1980s, the banking phase shifted the focus to building distance through multiple accounts and wire transfers. During the financial phase of the 2000s, the strategy redefined the money's economic identity. Criminals began using complex corporate structures and international fiduciaries to give illicit funds a new, legitimate biography. Today, in the global and digital hybrid phases, capital moves instantly through fintech platforms and serial transaction models. The intent is to render the money ambiguous and open to multiple, conflicting interpretations. This panel highlights excessive formalization. Launderers hide the truth beneath a massive volume of legally plausible contracts, phantom consulting fees, and intercompany loans that mimic routine business activity. This flawless documentary architecture is designed by white-collar professionals. Lawyers, accountants, and fiduciaries provide the technical expertise required to make these transactions appear routine and compact. Information asymmetry ensures that the complete picture remains with the launderer, while investigators find only disconnected transaction fragments spread across different jurisdictions and databases. The modern launderer weaponizes the overwhelming density of seemingly perfect, legally compliant paperwork to blind regulators. This perfection in paperwork allows illicit capital to enter a legal market sector with a unique set of competitive advantages. Legal market logic requires a legitimate enterprise to cover real costs, pay taxes, and generate a standard return on investment to survive. Illicit capital logic operates on different metrics. Success is measured by successful shielding and the integration of funds, rather than traditional profitability. Because the illicit operator does not depend on a standard profit margin, they possess a massive asymmetric advantage over every legal competitor in their sector. This advantage manifests first as predatory pricing. Firms using illicit capital can operate at a loss for years, selling products far below cost to bleed out honest businesses and capture the market. Launderers also target distressed companies. Bankrupt or struggling firms serve as ideal vessels to absorb illicit liquidity under the guise of a corporate rescue or bailout. This is compounded by tax fraud. Illicit firms frequently pair their untracked capital with evaded taxes, further lowering their operating costs relative to honest competitors. In such an environment, operational efficiency and innovation are no longer the primary drivers of success. Access to opaque capital becomes the deciding factor for survival. Illicit capital entirely rewrites the rules of competition, transforming free enterprise into a devastating mechanism of criminal dominance. A single illicit competitor can infect the broader ecosystem, forcing suppliers, vendors, and competing firms to adjust their behavior. Their irrational risk tolerance distorts procurement. They can overpay suppliers to secure loyalty or offer clients credit terms that legitimate businesses cannot match. This creates reputational contagion. Faced with impossible competition, honest businesses may lower their own compliance standards or enter into ambiguous partnerships just to remain viable. Eventually, these sectors develop insurmountable barriers to entry, physically locking out new entrepreneurs who lack access to criminal liquidity. The fallout reaches the valuation of physical assets, corrupting the prices of real estate, the valuation of raw land, and complex corporate shares. Asset prices inflate because they are no longer based on intrinsic yield. Instead, they reflect the launderer's desperate demand for shielding vehicles. When banks and creditors rely on these corrupted valuations, they inadvertently improve the standing of the criminal enterprise, accelerating its growth within the formal economy. Money laundering acts as a macroeconomic toxin that strips the market of its meritocracy and turns economic sectors into private fiefdoms. If accounting balances and paperwork are perfect, we must ask, how do we identify illicit intent? Investigators must move from standard procedural audits toward the framework of analyzing economic coherence. This approach searches for irrational market behavior within the data, identifying moves that have no logical business purpose. The first indicator is a mismatch between a modest individual tax profile and the rapid accumulation of high-value assets. The second is the use of layers of shell companies and exorbitant consulting fees that serve no actual industrial or operational function. The third is the rapid rotation of liquidity, paired with a protracted, unexplained tolerance for operational losses. While a single anomaly might reflect an eccentric business decision, the cumulative weight of multiple disalignments, mapped chronologically, strips away the veneer of legitimacy. This process builds the evidentiary bridge required to distinguish management irregularities from actual criminal functions. Financial data bypasses proxy directors and formal documents to reveal the true organizational structures and the real beneficiaries of a network. The indicator of criminal intent lies in the profound economic irrationality hiding underneath a flawless veneer of legal documentation. Traditional evidence is notoriously fragile. Witnesses change stories, allegiances shift, and physical contraband can be destroyed. The financial dimension provides a highly persistent relational and chronological footprint that cannot be entirely erased by conventional means. This investigative framework enables targeted asset confiscation, the process of stripping a criminal organization of its deployable power and market influence. Defeating modern economic crime requires analyzing the capital hiding in plain sight, rather than hunting for hidden cash. Forensic mastery lies in seeing past the illusion of perfect paperwork, to decode the economic reality and dismantle the asymmetric threat from the inside out.